Hi, it's Peter Schiff. It is Wednesday, February 20th, 2013. The price of gold dropped by about $40 an ounce today. Silver was down almost $1. In fact, we're trading at the lowest levels now since mid-2012. The downside actually accelerated late this afternoon after we got the release of the most recent Federal Reserve minutes, in which the Fed had a rather upbeat view or outlook on the U.S. economy. Now, I don't know why anybody puts any stock in what the Fed thinks. Remember, the Fed minutes from December, the last quarter of 2007, the Fed was even more upbeat, even though, unbeknownst to the Fed, we were already in a recession, and the worst financial crisis since the Great Depression was just around the corner. So I think the Fed has a pretty good track record of getting the economy wrong. Nonetheless, I think that rather upbeat view puts some additional selling pressure on gold and silver. Of course, the Fed gave no indication that it was going to stop its reckless money printing anytime soon. It's going to keep interest rates at zero. It's going to keep doing quantitative easing. There was some language about there may be needing a reason to adjust the size of their monthly bond and mortgage buying. Right now they're buying $85 billion per month. But an adjustment to the size doesn't necessarily imply a direction. I think some people on Wall Street might have interpreted that to meaning that they might scale it back. I think they're more likely to increase the size of their monthly bond purchases, because if interest rates are rising and if the bond bubble has burst, then the Fed is going to have to print a lot of money to keep the air from leaking out. The whole U.S. economy is being propped up by artificially low interest rates, and in order to sustain them at that level, it's going to require more and more money printing and quantitative easing, bond buying, on the part of the Fed. I think, though, the psychology behind the recent decline in the price of gold has to do with the more benign outlook for the global economy, and in particular, rising stock markets. The Dow Jones, which was off better than 100 points today. In fact, the NASDAQ dropped almost 50. But as of yesterday, you had the Dow and the NASDAQ at multi-year highs. And I think a lot of people were jumping to the wrong conclusion that a strong stock market was bad for gold. That if the economy was improving and the stock market was strengthening, there's no reason to buy gold anymore. The crisis is over, and so people are selling their gold. Well, first of all, if you look at the correlation between gold and the stock market over the last decade or so, they've been positively correlated. They rise and fall together. The main difference has been that gold has risen faster than stocks. The fact that they're moving in opposite directions is a recent phenomenon. But of course, the whole idea that because the economy is getting better and the stock market is improving, although I would debate that the economy is getting better, but let's accept that on face value, you have to understand why it's getting better. It's getting better because of all the inflation that the central banks around the world are creating. It's the monetary stimulus. It's 0% interest rates. It's quantitative easing. That's why it appears that the economy is improving. That's why the stock market is going up. And far from being a negative for gold, that's a huge positive for gold. People who are saying there's no reason to buy gold now never understood the reason people were buying it in the first place. People weren't buying gold because they were worried about a crisis in the Eurozone or weak U.S. stocks. People were buying gold because central banks were printing too much money. It was inflation that drives the gold trade, not political uncertainty. But the fact of the matter is, a lot of people who never understood why the gold market was rising might have bought some gold recently just to jump on the train, and now they're leaving it at the first sign of trouble because they don't really understand what's going on. Think about this. Last night in New Zealand, the head of the Reserve Bank there announced that if the New Zealand dollar didn't weaken, he was going to intervene to do that. He was going to sell New Zealand dollars to drive the currency down. Also in Norway this week, the head of the Norwegian central bank threatened to do the same thing. He said if the strength of the kroner means that inflation in Norway is not high enough, they're going to intervene to weaken a kroner so that they have a higher rate of inflation. This is typical of central banks all around the world. Look at Japan. Japan is trying to create inflation, and they're succeeding. As a matter of fact, as a result of the weakness of the Japanese yen, Louis Vuitton just announced a 14% price increase in Japan. So central banks are actually striving to create inflation. Here in the United States, the Fed is saying they're going to keep on printing money until they believe that inflation years in the future is going to be above 2.5%. But they don't care what it is now. All they care about is what they think it's going to be in the distant future. And we all know that it doesn't matter what they think, they normally get it wrong. But the point is this: central banks are now aggressively pursuing inflation on purpose. Before the financial crisis of 2008, most central bankers had a goal of price stability. That was seen as desirable. That was their objective, stable prices. Now, few central banks actually achieved that, but that was their goal. Central banks, some of them had inflation targets or limits, such as 2%, but it didn't mean that you wanted to have inflation of 2%. It just meant that if it got above 2%, that's when the central bank would really have to tighten to bring the rate of inflation back down to pursue a goal of price stability. Well,